Hello everyone, and welcome to this presentation of the three main components of a winning strategy. Welcome, my name is Stephen Primo. I'm the president and founder of Specialist Trading, and for those of you who are unfamiliar with my website, we just want to make this clear right off the bat that we are first and foremost an educational website. We're all about providing our members and our students with the tips and techniques that I've accumulated in my 39-year career so that you can ultimately empower yourself with this information to make your own trading decisions. I say this because I've been trading for that long, and in that 39 years I found out that the only way to really become consistent is not by being force-fed signals from some trading guru or from some website or from someone on TV and just blindly taking them, but from actually learning and becoming a part of the trading process and making your own trading decisions. Now, as I stated, I've been trading for 39 years. I started on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of them I was a specialist. Specialist was just a gentleman or a trader that made markets in roughly about 50 stocks. So I made markets during the crash of 1987 and the bull market that followed. And I left the floor in the 90s to manage money and to pursue my own trading account and to trade just about every market around imaginable. And in that 39-year period, I've seen what works and what doesn't work. I've traded every system, every technique, every methodology. I've been involved in every type of market environment. So I know what works in terms of consistency and I know what doesn't. So around 7 years ago, I teamed up with Pro Trader Strategies and formulated Specialist Trading, where all I do is teach and mentor my students the exact same things that I currently use in my own trading. Now today I'm going to share with you 3 of these really very powerful components that you can actually add to any current trading strategy that you have, or if you're so inclined, you can actually build a trading strategy based off of them. You're going to see how simple they are, but how powerful they are as well. These are tips and techniques that I learned from the floor, and I'm going to be sharing with you today. But before we begin, we are required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these 3 components, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So as you're taking a moment to view our disclaimer, I would also like to invite each and every one of you to follow me on Twitter. Here is our handle right there. You may want to copy this down at SPCLSTTRADG. Each and every day I post anywhere from 1 or 2 to maybe 10 different postings, anywhere from daily financial wisdom to actually signals that have been generated by our strategies. In fact, just a week ago today, I tweeted where 3 of our strategies, our proprietary market strategies in the indices, were generating very strong sell signals. And so we all know what has happened in the market since then in the past week. So I post this information for the people on Twitter, even though you don't know where we would exactly get in or where you would get out or where to place your stop. But it's just very limited. If you want a little bit more detailed information about what I do or how we teach, some videos you can watch, our sister site, which is Pro Trader Strategies, has put together a Facebook account for us. So you can go to protraderstrategies.com and simply log on there and watch any of the videos we have and a lot of more in-depth learning tools as well. So like us on Facebook. All right, so why don't we begin? Now, remember, as I stated in the opening statements just a few minutes ago, we are first and foremost an educational company. I know a lot of companies like to force feed people, their members, signals and tell them what to buy, what to sell, what market to trade, what's the best time frame. We really don't believe in that. Our philosophy is we give you the tools and information you need, but then we work with you and we mentor you to mold it to fit your needs. In other words, we find the perfect time frame for you. We find what style you want to trade, more aggressively, more conservatively. This means that 2 or 3 of our students can get the exact same signal and come up with entirely different results because everyone trades it according to their own needs. This, in my opinion, what I've learned after nearly 40 years of trading, is the only way one will become consistent in the markets. And that's what it's really all about, being able to trade 20, 30, 40 years down the road. So as you see here, my goal is not simply to force feed you signals. My goal is not to trade for you. My goal is to teach you how to trade with the specialist edge. This is the same edge that was taught to me nearly 40 years ago, and the same edge I give to all of my students and my members. Now, I'm going to give you some 3 great techniques today, 3 great components, once again, that you can begin using as early as tomorrow. But before we begin, I'd just like to state that since this is like a classroom, if you happen to have any questions, kindly wait till the end of the presentation. There's a box I have to open up to even see your questions. I won't even open that up until we conclude in about 20 or 25 minutes from now. So just wait till the very end of the class, and then we'll go over each and every one of your questions. The only question I will answer is probably the most popular one, and is this being recorded? Yes, it is. We record all of our presentations, so if you're having technical difficulties or if you have to leave early, you can contact Pro Trader Strategies, and they will send you a link to this recording. All right, so let's begin, and here's what you are going to learn in class today. We're going to start out with component number 1, which is really teaching you how to trade in sync with the market. I know everyone likes to trade in sync with the market. We're going to show you the easiest but the most powerful way to be in sync with any market in any time frame. Component number 2, we're going to talk about a specific price bar pattern. You should be looking for this price bar pattern in virtually any strategy or technique you're trading, because it's a message coming from the market telling you what it's most likely going to be doing in the next 3 to 5 bars. And then lastly, we're going to share with you an entry technique. Once again, you can apply this entry technique to any current trading method you're using. We really feel that it will increase your odds for success. All right, so why don't we begin? You're going to learn some great information here today. Let's start out with component number 1, which is simply stating you must trade in sync with the trend. Now, everyone knows this. I'm sure the first day you started trading, this is what you learned. In order to have some high probability trades, you must be in sync with the trend. But if everyone knows this, and if this is the common denominator amongst all traders, why do upwards of 80% of all traders fail? We think it's because everyone has a different idea of finding out and discerning what the trend is. Some people think the trend is looking at specific patterns, all right? Other people think it's looking at a higher time frame to tell you what to do on the lower time frame. Well, I specifically posted this generic chart here. You notice I didn't tell you what market we were in or what time frame, because I really want you to look at this and just look at this generically, because it will work virtually on any market, any time frame. Now, someone looking at this would say, well, Steve, there is no basic trend here, because we're basically going in a range. We're going down, then back up, then back down. So we want to stay out of ranging markets. That's what I've been taught. So there's no real trend. Okay, that's conventional wisdom. Well, that's not true at specialist trading. At specialist trading, there is a trend, and the way we find out is by simply applying the 50-period moving average. If the majority of price bars are above the 50-period moving average, as we see here, well then, it's telling you that the overall trend is up. And if the overall trend is up, we're only going to be buyers. We will never sell if price is above the 50. All right, this is probably the most important tool I learned on the floor of the stock exchange, and this has really kept me out of so much trouble and kept me on the right side of the market over the nearly 40 years I've been trading. Now, conversely, if we look at this chart right here, we see that, once again, someone could say we're just in a range here. We're not really going anywhere, so there really is no trend. But once again, that's not true. What do? We apply the 50-period moving average. We ask ourselves, where is price in relation to that? And the majority of price bars are below. So what is that telling us? The market is telling us, not some convoluted indicator, not some guy in a trading room, and not some very difficult price pattern or higher time frame, but the market is telling us that the overall trend is down. And if the overall trend is down, we will never be buyers. We will never buy below the 50-period moving average, because over time you will increase your odds for success by being in sync with the simple rule. Okay? Remember, it does not matter what strategy you trade, whether it's one of mine, one of yours, or someone else from another educator. If you get a buy signal, you should always be buying or entering your order above the 50-period moving average. If your buy signal is below the 50, please do not take it. It may work out, but over time you will ultimately most likely wind up with losers. All right, component number 2. Now that we know what side of the market to be on, we want to look for a bar that closes in the top or bottom 25% of its range. All right, so what exactly does that mean? Well, if we look at this price bar right here, it does not matter, once again, if this was a 5-minute bar, a weekly bar, or a monthly bar. Absolutely makes no difference. But what you want to do is simply divide it by 4 separate but equal parts. And if you close in that top 25%, as we do right here, and if this bar is above the 50-period moving average, well, then the market is telling you that most likely it's going higher. That's an indication to buy. Remember, we take all our cues from the market. We do not take our cues from a trading guru, from the interest rate news or for what's going on in China. We don't care about that. Remember I told you I tweeted a week ago, 3 of our strategies were generating sell signals in the market. Now everyone is saying it's because of China, because of worldly economic news. Well, we didn't know that a week ago. We got all of our strategy signals from the market itself, and this was one of the things that we looked at. All right, so this is a great indication to buy coming from the market. Now conversely, if we look at the chart here, we see that we are above the 50-period moving average, and these 3 bars here in green all closed in the top 25% of their range. Now let's look at the other side of the coin. Here's a bar that closes in the very bottom of its range, so you just simply divide by 4, and if you look at the very bottom 25% where we closed, and if you're below the 50-period moving average, well, the market is telling you that's an indication to sell. Most likely, we're going to be going lower for the next 3 to 5 bars. That could be the next 3 to 5 5-minute bars. It could be the next 3 to 5 monthly bars. It all depends what time frame you're looking at, but it's all relative. It absolutely doesn't matter, okay? So once again, let's look at that chart. We're below the 50-period moving average, and here's a bar that closes in its bottom 25%. All right, so we have component number 1 and component number 2. Now let's go to component number 3, which is our entry technique. And you must enter upon the confirmation of trend. All right, so what exactly does that mean? I thought the 50-period moving average was the overall trend. Here's the confirmation method rules. You may want to write this down, but you really don't have to, because once again, this is being recorded, so you can simply request a link to this and watch it as often as you like. But let's just say price is above the 50-period moving average. You have a bar that closes in its top 25% of its range. Now you want to buy if price trades 1 to 5 ticks above the bar that closes in the top 25% of its range. So if we look here at that chart again, and the 3 bars in green are the ones that closed in the top quarter of their range, we want to buy if we trade 1 or 5 ticks above. It's up to you. So if we look at that very first bar, we see here that this is where we want to buy. Now the standard rule is you want to buy most likely on the next bar. So in other words, you want to buy if we trade up here on the next bar. Now did we trade there on the next bar? No. So that's why we didn't get into this particular signal. Now this is why we suggest waiting for price to trade above these bars, because let's say you had simply bought at the close of this bar, or you bought at the market. Well, look what happened the next 2 days. I would venture to say that the majority of you would probably cancel your exit with a profit and sell at the market with a loss because it looks like it's going much lower. So this is why we wait for confirmation to trade above the bar in green, the bar that closed in its top quarter of its range, right? So there's no setup here. We go to the next one. Well, this is where we want to buy. Did we trade there? Yes, we did. You notice we did not close there. It does not matter where we close. All that matters is that we traded above the previous day's high. So this would be an entry. And as you can see, we went up for the next 3 to 5 bars. Not a lot, but it's all relative. Once again, these could be monthly bars for all you know. Now let's go to the last example. We want to buy if we trade above here. And we want to buy if we trade above there on the next bar. As you can see, we traded above there, so you would have entered. Remember, it does not matter where we close. We closed lower, but that's okay. You're in the trade, and this one worked out a lot better. Do you see how we're getting all of our signals from the market, from the chart in front of us? It's a lot easier. There's nothing you have to discern and figure out and decipher if it's good news or if it's bad news. Is this really support and resistance, or is this really support and resistance? Is this really a Fibonacci retracement, or I'm not sure I have the numbers right, or what count are we in the wave? You see, that stuff is just too subjective. It's too difficult to figure out. We want to trade things that are cut and dry, that everyone looking at the chart will get the same results, meaning that everyone knows in this chart in front of you, we're above the 50. There's no, room for discretion there. We're above the 50-period moving average. We know that the 3 bars close in the top 25% of their range. There's no way you can, alter that. They closed in the top 25% of their range. And we have to wait for price to trade above them on the next bar. It's all cut and dry. There's nothing you have to figure out or calculate. Now, let's say we want to go short. Well, we use the same confirmation method, but now we're going to sell if price happens to trade 1 to 5 ticks below the bar that closed in the bottom 25% of its range. So if we look at that example where the price is below the 50 period, That bar in red closed in the bottom 25% of its range, and this is where we want to sell, where that red dotted line is. But remember, we only want to sell if we trade below there on the next bar. We can't stick around and wait for 3 or 4 or 5 bars. We have to have it happen rather quickly. So we see what happened on the next bar. We traded there again. We did not close there. In fact, we closed higher. Don't worry about where you close. As long as you trade there, you should enter into the trade. Why? Because the market is giving you a clue that because you traded below the previous bar, most likely it's going to go lower. See how the market, once again, always wants to tell you what it's going to do. All we have to do is listen and then jump on board. All right, now we put these three very important and valuable components together into probably one of our most consistent strategies. That's strategy number 4. In fact, strategy number 4 only has 5 rules. I've just given you 3 of them. Okay, so I can't divulge all the rules, but let me show you some examples of some current trade signals that were generated using strategy number 4, and we're going to walk through all of these 3 components, and you're going to see how simply they work with strategy number 4. Let's start out with stocks, and we'll start out with letter K. Now, coming into this chart, we were originally below the 50-period moving average, but then in December, the majority of price bars started to close above. So what is the market telling us? The market is telling us the overall trend is up because we are above the 50-period moving average. If the overall trend is up, are we going to sell? No. So you see how simple this is. Automatically, we eliminate what we feel are half of your losses because you're on the right side of the market. All right, so we're only going to be buyers. Now, if we want to use this technique we just taught you, here's a bar that closed in the top 25% of its range. We're above the 50, and the automatic software for strategy number 4, according to all the other rules of the strategy, generated a buy signal. So we're going to go long, but we're not going to buy at the market. We have to wait for price to trade using component number 3. It has to trade above here on the next bar. All right, so let's see what happened. Well, yes, it did. In fact, it traded there, and we closed just like roughly right on it. So you would have been long letter K the first week of December, just about a month ago, and look what happened. The stock gained 4 points in the next 3 weeks coming into the beginning of 2016. Okay? We didn't look at any news. We're not looking at fundamentally how the company is doing. We're only looking at the chart in front of us. How about IBM? All right, this goes back to November into December. Where is price in relation to the 50-period moving average? Price is below. Very simple to see. So are we going to be buyers of this stock? No. We're only going to sell. Remember, once again, this is not a guaranteed rule where nothing will ever go up if we're below the 50-period moving average. All we're trying to do is get a level of consistency in our trading. And you will be more consistent if you are trading in sync with the overall trend. Remember, that's component number 1. And how do we find the overall trend? By using the 50-period moving average. So it's telling us here in mid-November that most likely it's going lower. IBM is telling you it wants to go lower because the overall trend is down. So we find a bar here that closes in its bottom 25%, and the software for strategy number 4 generates a sell signal. Now we just can't go short at the market. We have to wait for price to trade below that bar on the next bar only. So let's see what happened. Well, we traded there. In fact, we went lower. So you're in the trade, you're short, and look what IBM did. In the next week or two, coming into December, it was down 10 points. Okay? Remember, once again, the best thing you can do is be in sync with the market, and the easiest way to be in sync with the overall market is to apply the 50-period moving average. Here's another example in MCK. Now, once again, someone could look at this chart. This was just a few weeks ago, and someone could say, well, Steve, there's absolutely no trend here at all. I mean, look at the bar charts. We're going up, back down, back up, back down. We're in a complete whipsaw range. So I'm not going to do anything because we're in a rangy market. Okay, this is the way we're usually taught. This is the way I was taught. Okay, until my mentors took me aside and said, don't listen to that. All you have to do is apply the 50-period moving average. Ask yourselves, where are the majority of bars in relation to this 50-period moving average? They're above. So what is MCK telling you? It's telling you the overall trend is up and to look for buy setups because most likely it's telling you it wants to go higher. So as we see here, there's a bar that closes in its top 25%, and we can buy on the next bar if we trade above there. But as we see here, we never traded above there. So there was no buy there. And as you can see, MCK went up a little, then right back down. So it wasn't ready to bust out yet. There was no confirmation. But then we got another setup right here, just a few days later, and we can only buy if we trade above here. Now the software generated a buy signal, and once again, we're going to buy right here on the next bar, but we have to trade there on the next bar. And we did. We entered the trade, closed lower, but look what happened in the next week. Went up 10 points. So don't ever let someone tell you there's no trend. The market was telling you way back as soon as the beginning of December that we're in an uptrend. Why? Because the majority of price bars were above the 50-period moving average. Once again, the market is always telling you what it wants to do. The trouble is, none of us want to listen. We want to use some indicator, we want to listen to some guy on TV, or we want to figure out what the news is telling us. There's too much discretion involved in that. It's much easier and a lot cheaper to listen to the market. I want to show you this chart here, the ETF for the Russell 2000, that's IWM, because you can use this for indices as well. Now here's a signal that was generated a week ago, the 30th in the IWM. Now first ask ourselves, where is price in relation to the 50? Well, price is below, okay? Now we have a bar here that closes in its bottom 25%. And the software generated a sell signal. Remember, this was a week ago. This was before the markets fell out of bed. How did we know the market was going to go lower? The market was telling us. Nothing else was telling us. We didn't know what was going on in China. You know, no one in China called us up and said, hey, you guys may want to short the markets here because we're going to get some bad economic and fundamental news about the country coming out. So you may want to sell and tell all your clients and members to sell everything. No one told us. The only thing we took our signals was from the market, and that's the chart in front of us. The daily chart was below the 50. We have a bar that closes in the bottom 25%. The remainder of the rules were all met according to strategy number 4. All we have to do is wait for price to trade right below, and that's our entry. Now, had we not traded below, we would not have gone short, but we did, and we all know what happened. Now, this was only coming into the first day, actually Monday of this week. We all know the market has gone a lot lower in the next days of this last week. Now, let's look at some E-mini setups, and I'm going to show you some more advanced trades because this is for more advanced traders. Even though we still use the basic format of these rules, we've stretched them a little bit to be a little bit more aggressive. Remember, no two traders should ever trade alike. We have some traders that trade more conservatively. We have others that trade more aggressively. There's nothing wrong with that. As I stated in the opening statement, we provide you with the information, but we want you to be in charge of your trading decisions. So if you'd like to trade more aggressively, here's a perfect example. Let's start going back to August. Okay, as we look here, here was a very aggressive trade to go long the E-mini. This was on August 10th, going back this past summer. Now, the reason why it's aggressive is because there's no clear cut as to what side of the 50-period moving average we're on. We keep going above, below, but all the rules were met for strategy number 4, and we closed above the 50. So as long as you close above the 50 and your entry is above, it does not matter if all of the bars are above. Okay, this is a more aggressive way to trade it. And the reason why is because it's not guaranteed it's going to have as much consistency. As you can see, this was a losing trade. You most likely would have been stopped out somewhere around here. Okay, but you're an aggressive trader, so that comes with the territory. So you're stopped out on a losing trade in mid-August. So another week or two passes until ultimately we go a little forward and the market closes back down below the 50 period, once again in this oscillating mode. But guess what? The software generates an automatic sell signal, this time on the 19th of August. Okay, so it's a more aggressive setup again. The majority of bars are not below the 50 period, but as long as your entry is below the 50 period and all the rules are met, and you're a more aggressive trader, you can take this setup. So let's see what happened. The next bar went lower, so you would have been short the E-mini futures on a daily basis. And then we all remember what happened in August. The markets were down 1,000 points one time intraday. And had you stayed into this trade roughly 3 days, that's 230 points. That's over $12,000 per contract. Okay, if you were trading, multiple contracts, you can just see how easy it is to generate gains. These are all using the same 3 components we just talked about. Now, I know we're going back roughly 6 months ago, but let's see what happened just this past week. Here's another chart, a daily chart of the E-mini. Now, coming into the end of December, we are below the 50-period moving average. All right. We have one day where we close above it. It doesn't generate a buy signal, but then the very next day we close back below. Once again, this is a more aggressive type of trade because we don't have a majority of bars below or above. We're kind of oscillating above and below. But it still generated a sell signal. Why? Because we close on the very bottom 25% of the range. Here's the bar we talked about. We close below the 50, and all of the other rules were met. So this generated a valid sell signal. Once again, on the 30th, this was just a week ago today. This was one of the signals we tweeted about using the three components I'm sharing with you today. So if you were a more aggressive trader, you could have used this to go short on the next bar only, and you would have gone short. And this was on the 31st, the last trading day of the year. And, well, we all know what would have happened had you stayed short this past week, okay? Now, as we said, we did not look at any fundamental news. We didn't care what's going on in China. We weren't talking about things, what people thought of on TV or in a chat room. All we do is take the information that has stood the test of time, the same things that were taught to me almost 40 years ago, and then apply them and trade them to meet our needs, whether we want to trade them aggressively or conservatively. Now, those are daily bar charts, more aggressive. Let's look at some just more conservative ways of trading. This was just a week or two ago on a 10-minute time frame. As we see here, coming into this day on a 10-minute time frame, for intraday traders, we are above the 50-period moving average. So this means we're only going to be buying. We are in no way going to sell on a 10-minute time frame. And the software generated two buy signals. Okay. Now, we can only buy if we trade one or two ticks above, and we did. You would have been long both of these right here. So how could you know if this was going to work out or not? Well, on a 10-minute time frame, you're long, and in the next 2 days, if you had held on, you would have gained 40 points. That's $2,000 per contract. Okay? You see how easy it is to be a consistent trader when you're in sync with the 50-period moving average. What most traders would probably be doing here is trying to sell into this a couple of weeks ago. All right? We're never going to sell above the 50. If price is above the 50, we're only going to be looking for buy setups. Now, just to show you that we're not cherry picking, let me show you what happened today. Okay, I took the snapshot just about a half hour before today's presentation. This is a 15-minute chart of the E-mini. If you look down in the lower left-hand corner, you'll see here this is January 7th, 1/7. All right. We all know that the market gapped down lower from yesterday. We gapped down and then we started to rally. Now, a lot of people were saying, hey, Steve, I think we bottomed out. Does this look like a buy signal? Because it looks like we're going to be going higher. We open on the extreme lows, and this could be a reversal. Okay. First thing I tell all my students, where is price in relation to the 50-period moving average? If price is above, then we'll be buyers. But where is price right now? And everyone said, no, price is still below. Regardless of what time frame I'm looking at, the majority of price bars are below. So I said, so there's your answer. There's no reason to ask me what I think. In fact, there's no reason to ever ask anyone what they think. If you know you're above or below the 50-period moving average, you already know what side of the market you should be on. Okay? So on this 15-minute chart, even though price was rallying the first hour or two, we're looking for sell setups. And guess what? What do we find right here? A bar that closes in the bottom 25% of its range. Component number 2. All right? Component number 1, we're below the 50. Component number 2, we close in the bottom 25% of the range. All right? So all the other rules were met, and strategy generated a sell signal. But we cannot just sell at the market because it may be wrong. You know, I'm not going to sit here and tell you that every strategy signal works. Sometimes they open up and then go higher. So we want to wait for confirmation. This gives us higher probability entry. We have to trade below this bar on the next 15-minute time frame. And as you can see, we did. And I took the snapshot coming into the last half hour of the day, 12:30 Pacific time. And that was 30 points had you stuck in the entire day, which is about $1,500 per contract. This was happening today, just a few hours ago. Now, I'm not saying that every one of our students who took this trade made 30 points. Some got out with 1 or 2 point gain. Other got out with maybe a 10-point gain. Someone just sent me an email before I started this presentation saying they shorted this signal and made roughly about 13 points. That's fine. So you see that it's up to you how you want to trade it. We do not teach or trade systems. We do not believe in that because once again, everyone should be trading according to their own parameters. If you want to trade conservatively, you want to get in and out rather quickly with some small risk, or if you want to trade aggressively, you want to go in for the long haul, try and squeeze as many points as you can. There's nothing wrong with either one. The only thing that's wrong is if you try to trade mimicking someone else's style. That is a recipe for disaster. That's why we don't have chat rooms or trading rooms at Specialist Trading, because traders turn that into a crutch. They think that they're supposed to copy what I'm doing or copy what someone else is doing. You should never copy what anyone else is doing. That's why we don't tell our members to simply blindly take our signals. We're giving them as a service, as an educational tool, so you know what to look for. So this happened just a few hours ago. This was a nice trade that a lot of our members took today. Now let's just go in one last market, the currency pair market. These are the Forex markets, and as you can see here, this will work in any market in any time frame. Here's a weekly chart of the Canadian dollar. First thing we ask ourselves, component number one, what's the overall trend? Well, price is above the 50-period moving average. This dotted green line here on the bottom, you can barely see it, but that's the 50-period moving average. So if price is above, are we going to be selling the Canadian dollar? No, we're only looking for buy setups. Okay? Now we look for component number two, a bar that closed in its top 25% of its range, and that's right here, circled in blue. So we have component number two met. Now, those are two of the rules of strategy number four. Two others were met, so the strategy generated a buy signal. Now, rule number five is we cannot enter at the market. We have to enter if we trade above this on the next weekly bar. So as you see here, here's the next weekly bar. You would have entered into the trade if you were going long the Canadian dollar on a weekly time frame. And in a matter of about 6 or 7 months, that's 1,100 pips, or roughly $11,000 per contract. You see this works on weekly charts, daily charts, 10-minute charts, Forex markets, currency pairs, ETFs, futures, stocks. It absolutely does not matter. These components will work in any market, any time frame, in any direction. All right, so let's recap before we go to question and answer portion. Here's what you learned today. We talked about the three main components. Trading in sync is the first one, and in my opinion, the most valuable, because this will probably eliminate half of your losing trades. In fact, I would almost dare you to go back and look at your last 10 or 20 trades, most especially look at the losers. I can almost guarantee that the reason why you had the losers was because you were buying, most likely buying below the 50-period moving average or selling above the 50-period moving average. Most traders do that. In reality, you should be doing the opposite. You only buy above the 50 and only sell below the 50. Okay? I'm not saying that this is guaranteed for a winning trade, but it's really meant to get you in consistency with the trend. And that's what it's really all about, because once you have this consistency with the trend, you'll have consistency in your trading, and you'll be able to sustain yourself for 20, 30, or 40 years down the road. All right? So after component number one, you look for component number two, which is a price bar pattern. If price is above the 50 period, look for a bar that closes in its top quarter of its range. If price is below the 50, look for a bar that closes in the bottom 25% of its range. Why? Because this is a tremendous clue. Once again, not coming from somebody in a chat room or some guy on TV or somebody even in a webinar. It's a clue coming from the market. The market is telling you most likely it's going to go up for the next 3 to 5 bars. What a great edge to have, having a signal come from the market. The thing you're trading is telling you what it's most likely going to do. And then component number three is simply an entry technique, which you can virtually apply to any trading strategy. And that's, once you get a signal, regardless of what it's based on, don't simply buy at the market or place a limit order. Buy once price trades 1 or 2 ticks above that entry bar. Sell once price trades 1 or 2 ticks below. You'll really increase your odds for success because you're waiting for confirmation that you're going in your desired direction. These are 3 extremely simple but powerful components, once again, that you can add to any strategy you currently have. We showed you how it builds and is the format, the basic format and benchmark to one of our most consistent strategies, strategy number 4. Or you can actually build a strategy based off of these 3 main components. Now, at any time, we are using either one or all 3 of these components in any of our strategies. Some of our strategies only use 1, some of them use maybe 2, some of them use all 3. But we are at any time at least using one of these in some of our strategies. So, as we close here, I want you to ask yourself, and ask yourself honestly, do you think any of these edges I revealed today could have helped your trading this past year? Even if it's just one of them, do you think they could have helped? Okay. Now, what if I could give you maybe 3, 4, 5 more edges just like this, but based completely off different information, a completely different format? Okay, well, this is what we're offering all of our attendees today. This is today's special attendee discount, and it's our Secrets of a Stock Exchange Specialist training sessions. What this is a 3-hour video. It's a video seminar. I was asked to speak about 2 or 3 years ago in Denver, Colorado. I was the head featured speaker at a conference there, and I spoke for 3 hours, and they were lucky enough to videotape it for us, and they gave us the video, a high quality video, and for 3 hours I spoke about many more high probability trading edges, very similar to the ones I just talked about today, but entirely different. I talked about which indicators to use, which ones not to use. I go into the difference between the system versus a strategy, and I think probably the most important thing I gave on this presentation were the complete rules to one of our best pullback strategies. That's strategy number 1. In fact, let me share with you some recent examples of strategy number 1 signals that were generated in the market. Okay, some recent strategy number 1 signals. Let's start out with PSA. This was just a couple of weeks ago. As we see here, it looked as if the stock was rolling over and heading lower, but according to the strategy, this was simply a pullback. It was time to go long, and as you can see, this is component number 2 here, closing in the top 25% of its range, and the stock went up 8 points in 1 day. Now we realize this is an expensive stock, but you could have just as easily, instead of purchasing the stock, purchased calls or purchased some type of spread to go long the stock, because it has a very high probability for having some really nice pullback trades. All right, that was in PSA on the 12th of December, or I should say the 14th of December. Now let's look at American Express here. As we can see, we had 3 really nice sell signals generated starting in November all the way into the middle of December, the same time period. The strategy said that we're in a downtrend, and each and every time we had a nice bounce, look what happened. A sell signal was generated right around the top of that bounce. The market went lower. We have another small bounce here, another sell signal is generated, and we have another move to the downside. Another bounce is here. A lot of people would be saying, well, this is where we're bottoming out, but the strategy generated another sell signal, and look what happened in the next 2 days. And now coming into this past week, we had another rally here. Now a lot of people were saying, well, it looks like a double bottom. The market has been going down for a while. There's no reason I want to sell here anymore. But lo and behold, the strategy generated another sell signal on the 29th of December. This is strategy number 1. So had you taken that, well, look at the nice gains you would have had, roughly about 9 points this last month. Now these are in stocks. We can also apply this to intraday trading of the E-mini. The same rules. Nothing has changed because we're changing the market or the time frame. As we see here, this was a couple of weeks ago, on a 1-minute time frame, the E-mini futures went up very, very strong. And then we hit some type of top here, resistance, and this is where the sellers came in. A lot of people were thinking, well, looks like we're going all the way back down again. There's a lot of selling pressure. Strategy number 1 generated a buy signal right at the very bottom of this pullback. You could have entered, and in the next closing hour generated a 10-point gain. Now lastly, we can go to daily charts of the currency pairs. Here's the British pound coming into December. We had a really nice rally. A lot of people thought the British pound was headed higher. Strategy number 1 deemed that we were in the overall trend was down, and this was just a pullback. So it generated a sell signal a couple of months ago, and the British pound fell out of bed. Okay. Now, a lot of people thought, well, you know what? We pretty much hit a bottom here, a really strong downward day. Most likely we're going to bottom out. And we started to rise again. But on the 11th of December, strategy number 1 generated another sell signal. And look what happened. So a total of 500 pips in the past month. That comes out to roughly about $5,000 per contract. So these are the same rules, regardless of market, regardless of time frame. This is our most consistent pullback strategy. If you notice, the 3 components I was sharing with you today aren't necessarily deemed for pullback trading. Every once in a while you will get pullback setups, but strategy number 1 is specifically designed to trade in sync with the trend, but get you in at lower, more inexpensive prices because you're purchasing on a pullback. Same way with going short. Now in this training session, this video seminar, I give all of the rules to this particular strategy. Today I only shared with you 3 rules to strategy number 4. With strategy number one, I give you all the rules: where to buy, where to sell, where to place your stop, different exit patterns, everything you need to know to trade strategy number one, whether you want to trade it aggressively, conservatively, if you want to use the standard format, we give you different options to trade it conservatively or different ways to meet your needs. This is all included in the course. 3 hours of trading techniques plus a full strategy, full-fledged strategy, as you just saw. Now, on our sister site, Pro Trader Strategies, they market this 3-hour video course for upwards of $1,000. But for all the attendees today, we are drastically dropping the price to $37. You're getting all of my high probability trading techniques, similar to what I just shared with you today, along with all of the complete rules to strategy number one. And included with that, you're getting my personal email address. You can contact me whenever you like with any questions, because now you are a student of mine for life. This is all discounted down to $37, but for a limited time only. So if you want to really take advantage of that before price goes all the way back up to nearly $1,000, here's how to contact us and get that deal. Pro Trader Strategies, once again, you can email them at trading@protraderstrategies.com or call them directly at area code 310-598-6677. Or you see the link at the very bottom of the page here. That's the link to go to the sign-up page for the $37 offer. Now, that's not a live link. If you want to just go to, you have to copy and paste that. So if you want to go to a live link, if you look on your chat box, right, by the question and answer box, you'll see that Pro Trader Strategies has posted a live link. So all you have to do is simply click that on, and it will take you to the $37 sign-up page, okay? I'm going to leave this information up here while I open up my question and answer box. I want to thank you all for holding off on any questions. And if you do happen to have questions, let me get to them right away here. Okay, let's see. Vince is asking, why didn't you buy on the second candle? I'm sorry, Vince, I'm not sure which chart we're talking about. If you're talking about buying, though, I think you were looking at a bar that closed in the top 25%, and you're wondering why we didn't buy there. Remember, we were probably looking at strategy number 4 setups, and there are 2 other rules that needed to be met with strategy number 4. I just can't disclose those right now because it wouldn't be fair to the people that have purchased the course. So that's why you're probably wondering why some of those bars that did close either in the bottom or top 25% of their range were not executed. It's most likely because they did not meet the requirements of the strategy, okay? Another question, how many bars do you wait to get confirmation? Well, just one. So in other words, if you are above the 50-period moving average and you see a bar that closes in the top 25% of its range and it meets all the rules of whatever strategy you're trading, all right, well, that's where you want to see it trade above that bar, and it has to trade above on the next bar. Why? Because we're looking to catch momentum. We want to confirm that we're going higher. And if we don't trade there on the next bar, most likely we're not going to go higher. So we have to have it happen as soon as possible, okay, for this particular setup, okay? Bruce is asking, is the 50-period moving average, is that simple or exponential? Well, you know, there's no real steadfast rule to that. I use the simple moving average simply because it works so well. But there's nothing wrong with using exponential. The main thing I want to pass on to you is that this is just designed to get you on the right side. So in other words, what you should be asking yourself is, where is price in relation to that 50-period moving average? And then once you decide where the majority of bars are, that's the only style you're going to be trading, whether long or short. So it's not a signal to buy at the market or sell at the market. It's not a trading strategy. It's just telling you what side of the fence to be on. Once you know what side of the fence to be on, you can virtually trade any strategy. So look, as I stated earlier, look at your last 10 or 20 trades. See how many were in sync with that rule. And I can almost guarantee you the ones that you lost on were because you were out of sync with that. So it doesn't matter so much if it's exponential or weighted or simple. I like to use the simple moving average because it works so well with every market. But experiment with it. Once again, become a part of the process. These are not systems. We want you and we encourage you to decide for yourself how you're going to trade. We're just giving you the basic benchmarks, and then we want you to decide. Remember, I stated almost an hour ago, the only way in my nearly 40 years of trading that a trader becomes consistent is by making their own trading decisions. Never mimic what someone else is doing in a trading room, a chat room, or on TV, or even in a webinar. Take the basic information, but then mold it and design it and set it to meet your needs, okay? If the information is solid, if it has stood the test of time, it's okay to alter it a little bit as long as you keep the basic format intact, all right? Let's see, Noel is asking, how long should the buy-sell candle be for it to be a valid signal for number 2? No, I'm sorry, I'm not really sure what you mean by for number 2. Are you talking about for component number 2? How long should it be? What the length of the candle should be? Or how large should that be? I guess. Once again, this is subjective. It's up to you. There's no right or wrong answer for this. Like I can't tell you that it has to be at least 2 or 3 points because we have members that use this on a 1-minute chart, and a lot of the length of those bars are maybe only 3 or 4 ticks. So just take the information and work with it, and once again come up with something that makes you feel comfortable. You now have these 3 components, so don't just take someone's word for granted that, okay, it has to be at least 2 points long or something. It's up to you. See how well it works for you, and then you can figure out what the perfect length of it is, okay? Lou says, you say regardless of time frame, will this work on 1-minute charts? Yes, Lou. In fact, I showed you an example with 1-minute charts, so I guess it does work. If we looked earlier, we saw that actually with strategy number 1 worked with 1-minute charts, but if it works on 15-minute charts, trust me, it'll work on 1-minute charts. In fact, it works on tick charts. I use this on tick charts, 1,000 tick bar charts, sometimes even 500 tick bar charts. So it's up to you, but experiment with it. You have the rules. Remember, this is not a system. You can see how well this works by just a careful observation and a little bit of research on your part. We encourage this. This is how you become a part of the process, okay? You can see how your questions are geared towards having someone tell you what to do or how to trade. This is the way we've been taught. We're the opposite of specialist trading. We give you the information, but then we want you to go do the research. Go look and see what works for you. You have the basic fundamental information in front of you. Now go see if you want to trade it on a 1-minute chart that doesn't feel comfortable for you. Go to a 15-minute chart. If it still doesn't feel comfortable, maybe go to a 10-minute chart or maybe go to a tick chart. It's up to you. There's no right or wrong answer, okay? Sam is asking, I signed up for the $37 deal. $7. There's no, well, first of all, there's no chat room. Sam is saying that plus a chat room. You're also asking about strategy number 4. Well, strategy number 4 is not included in this. What's included in this is strategy number 1, okay? So strategy number 1 is included in this. So strategy number 4 is a separate entity unto itself, but I'm sure they have some discounts of Pro Trader Strategies. The email address as well as the phone number is right here. Tell them you purchased this $37 deal, and if you're interested, perhaps they will give you a deal on strategy number 4 as well, okay? So you can have both of those probably for some really nice, inexpensive deals here. But once again, Pro Trader Strategies handles all of that. It's up to them to put that together, okay? In conclusion, we just started out the year here, 2016. I know a lot of you have all these goals, hopes, and aspirations for how you want to do this year. And most of us, I hate to say this, but it's reality, most of us will never meet the goals we set at the beginning of the year. It's just the way it is. The 80% of most traders ultimately fail. If you really want to get on track for just an extremely inexpensive price, I very strongly urge you to take advantage of this deal. $37, down from $1,000. It doesn't get much cheaper than that. Loads of information, plus a full-fledged strategy, plus you are my student for life. You can contact me whenever you like, and I get back to you as soon as possible. All for only $37. I'm sure many of you, most likely, probably spent more than that just trading today. You can't go out for dinner for 2 for less than $50 or even $100 these days. So for $37, you're getting a lifetime of information. So if you're interested, really take advantage of that. A couple of people I see are asking about the Twitter address. If you have a pencil and paper, just write this down. Remember, it's at SPCLSTTRADG. That's abbreviation for specialist trading. At SPCLSTTRADG. Okay? I want to thank you so much for joining us today. I really hope you enjoyed the presentation. I hope you get something out of it. But most importantly, I look forward to all of you becoming students of mine at Specialist Trading and taking advantage of our deep discount for a limited time. Thank you so much for attending today, and I wish you the best of luck. I'll see you all next time. Bye-bye.